Learning how to invest money for future returns isn't an easy task. It can be fraught with failure because being a good investor isn't just about choosing the right investments. Let's get some details with independent financial advisor David Sharpe. Thanks for coming in.
Hi, Monica.
What are the common investment mistakes people make?
Look, there's a few, and I'll probably break it down into sort of financial literacy and our own sort of financial behaviour. But I really want to call out one of the risks, which is inflation that often a lot of us ignore. And, we might have $100 and we're a bit too nervous to invest it. And that $100 maybe 3 or 4 years ago, if you went to Coles, would have bought you 50 2-litre, cartons of milk. Right now, if you go into Coles, it's going to buy you 42. So even though you haven't, invested that $100, it's still $100. Your purchasing power has come down significantly. You are losing money because inflation erodes it along the way. In terms of our own behaviour, we have this recency bias. We know the Perth property market surged for the last 12 months, so everyone thinks, I'll buy an investment property, but that return's already captured. It's already happened. It doesn't mean it's going to continue to happen, certainly at that same rate. And lastly, the two E's, ego and emotion. Too often we're making irrational decisions on our money, and that often comes with a recipe for disaster, and it's going to cost us a lot of money.
Some of these concerns, behaviours and decisions might put many people off, but we shouldn't be afraid to invest, should we?
No, absolutely not. And for the vast majority of us, we already have a significant investment that we're contributing money to regularly, which is our super. And, that goes up and down. It has good days, bad days, and good years and bad years. And I stress that about bad years, because if we looked over the last, say, 50 or 60 years on the Australian stock market, a little over 1 in 4 years is negative on the stock market. So that sounds bad. And that whole fear of, I don't want to lose my hard-earned money. But if you hold on for 10 years, we're yet to have a 10-year period over that time frame that is negative. So while there is risk in the short term, you hold for the long term, you're going to often have a really, really positive experience.
OK, Sharpe, so talk us through the statement that being a good investor isn't just about choosing the right investments.
Yeah, look, there's this common belief out there that, the wealthy have some sort of secret they keep close to their chest, or you've just got to find some U-Butte investment and, everything will be apples. And while that might be true, but it's a bit like winning lotto at times, finding that great uranium stock. The reality is there's lots of great investments out there, but they're not necessarily great for everyone. So we talked about property already. There might be this great investment property with great long-term investment returns, and that might be good for someone in their 30s and 40s trying to save for their retirement. But if you're in your retirement, you can't sell off the front door. You can't sell off the bathroom only. You might need that capital to put food on the table or to take holidays. So it might be a great investment, just not great for everyone.
Finally, what are Sharpe's tips this Tuesday?
Well, be very, very clear about the objectives you're trying to achieve with your money, and make sure your finances fit your objectives, not someone else. Have your own strategy. Don't listen to what your neighbour's doing or what your brother's doing. Have your strategy and stick to it, because discipline and time is going to be your best chance of a successful investment experience, not continually trying to chase the golden goose.
As always, appreciate your insight.
Thanks, Monica.